Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So let's say I sell the 2021 call spread at 35 cents. So the 20 calls, buy the 21 calls. Taking a credit of 35 cents, so that's more than the 25 that I require myself to take. And let's see. The most I can make is 35. The most I can lose is 65. So that's way better than my 1-to-5 ratio. This is like about a 2-to-1 ratio. I can make 1 and lose 2, basically, right? I can make 35 and lose 65. It's like 1-to-2. You know, maybe the stock is at 19 bucks when I make this trade. If the stock's at 19 bucks, well, it's easier if I show you on the P&L diagram. If the stock's at 19 bucks when I make this trade, you know, if we talk to a professor or some sort of statistician, he'll say, well, it's got a 50-50 shot of going up, 50-50 shot of going down. Now, if we're good at reading volatility charts, or excuse me, price charts, we could probably do better than 50-50, I think. You know, not 100% or 90% winners, better than 50-50. But let's just say that, you know, we're terrible at reading volatility charts, and it is pretty random. Like, all our picks have a 50-50 shot at winning and losing. Well, if that's the case, if the stock's at 19, there's a 50% chance of it falling below 19, and a 50% chance of falling above 19. Now, if it goes a little bit above 19 or stays at 19, I'm a winner. So 50% chance of it being a loser if it goes down. And if it stays where it is, I'm a winner. And if it goes up just a little bit, I'm a winner. Just if it goes up too much, there's too much volatility to the upside, then I lose. So the odds are better, maybe significantly better, than 50% chance that I have a winner here. It's a high probability trade. And in fact, as long as the stock stays below 2035, I'm a winner. Now, Lawrence asks, Dan, what is a realistic, consistent return that one can reasonably achieve monthly by selling those credit spreads? And he adds that he's a newbie. Lawrence, that's a great question. I see sometimes online people say, oh, you know, you make 15% your first month with me when I teach you, you know, and is it possible to make 15% a month? Sure. You know, is that something anyone could possibly guarantee you? Surely not. You should make money just about every month when you're trading with edge on high probability income trade. But you're going to have some months when you lose. If you have a knack for it and you're trading for edge, you probably shouldn't lose more than 1 month a year. And when you do lose, it shouldn't be a lot. You got to protect yourself from these big losses. So, you know, I kind of like to stay general because I don't like to imply that, you know, hey, if you just follow what I'm saying, you're going to make, you know, hundreds of percents, you know, a year or something like that. But I will tell you that anecdotally, from students getting back to me, they say that they're making reasonably good returns. Now, Jeff says, if you place the trade and it starts to go against you, is there a way to adjust it? Yes, Jeff, there is. It's a little out of the scope of what we're talking about here, but I will show you how to access some of that material on my website when we get done here. And John asks, how is there 65% loss potential? Here's how. With the stock at 19, we sell this 2021 spread for 35 cents. If the stock remains below 20 by expiration, both of the options expire and we keep 35 cents as a profit. Let's say the stock goes up. It goes really high up. It goes up above 21. Well, that 35 cents is still ours. But we get assigned on our 20 calls, and we get short stock at 20, and we can exercise our 21 calls and buy the stock back at 21, so we negative scalp $1. So we lose $1 if the stock's above 21 at expiration, but we still have that 35 cents. So our net loss is really only 65, John. Now, I don't want to spend too much time on this, but this is kind of what ultimately becomes the important stuff that separates the men from the boys or the women from the girls with credit spreads and iron condors, is using the Greeks, delta, theta, and also vega. This has the directional sensitivity of being short 11 shares. That's what this negative almost 11 delta means. I make a half a cent a day because I collected 35 cents and it gets worth about a half cent less every day. Tomorrow it's worth 34 and a half. The next day it's worth 34. That assumes, of course, we're not making or losing on delta or vega. All else held constant. And if we sold volatility that was overpriced, and maybe volatility falls, say, 5 points, we're going to eke out an extra 3 cents, which in this case is almost 10%. Because when implied volatility falls, the option price changes by the amount of the vega. If implied volatility falls 6 cents, or excuse me, if implied volatility falls, say, 5 points, and our vega is short 6 cents, it's 5 times 6, that's 5.006, that's 3 cents extra that I would make on the trade, given just that slight 5-point drop in implied volatility. Now, this is 3 cents on a 35-cent trade, but if the net credit was bigger, the vega would be bigger, and a difference of 10% on each trade is not outside of the realm of possibility. That's why doing a volatility analysis is so important. You can make more on every trade on your winners. You can lose less on every trade on your losers. Now let's zip through a put credit spread. That's when I sell one put and buy another on the same underlying in the same expiration month, but the put I'm buying is a lower strike price. And the goals are the same, profit from theta without having the underlying stock move too much lower. And hopefully we stay above the break-even price by the time expiration rolls around. The put credit spread P&L diagram looks like this, just the opposite. Ideally, I want to stay above the short strike price by the time expiration rolls around. That's where I reach my maximum profit potential. If the stock falls all the way down below the long strike, that's where I reach my maximum loss. It's kind of the same thing as a call credit spread, but just upside down. Here I want maybe a slow, steady bull trend, or a stock that's in a channel that's bouncing off support. No news in the pipeline. Implied volatility is moderately expensive. And I'm getting a payout of at least 1 to 5, right? Risk 5 to make 1. Again, high probability trade. And I need to get at least a 25-cent nominal credit on every trade. So let's say here I sell the 67.5, 72.5 put spread at 90 cents. Here my max gain is 90. My max loss is 410. My break even, which I'll show you, is 71.60. So the goal is, as long as the stock, the stock is probably at like 71, say, when we make this trade. Not necessarily a bullish trade, it's just like a not bearish trade. As long as we stay above that 72.5 strike, when expiration comes around, the options expire, and we keep that premium. If the stock falls all the way down to 67.5 or lower, we'd have our maximum loss. Why? Because we'd get assigned on our 72.5 puts, and therefore get long stock. And if the stock falls all the way down to 67.5, we can exercise our long 67.5 strike puts and sell out that long stock and truncate our losses. See, this is kind of the same concept. The only thing that's different is the sign of the delta, really. We have a positive delta. We have a slight bullish bias to put credit spreads. We have a slight bearish bias to call credit spreads. Here our theta is, 2.68 cents a day, and our vega is almost 3 cents a day. Here, if implied volatility falls, say, 5 points, we make an actual 6 cents. It's on a 90-cent trade. That's, what is that? About 7%. And, I'm saying if implied volatility falls 5 points, that's a little bit of an arbitrary figure. If we're selling moderately priced, moderately higher priced implied volatility, anywhere between 3 and 7 points is about right. So I'm just kind of using 5 as a benchmark. We're able to squeeze out maybe an extra 5 to 10% on this trade by vega. Now, Dan says, how does vega relate to historical volatility? In a roundabout sort of way it does. It mostly relates to implied volatility, though. It directly relates to implied volatility. When implied volatility changes, your option prices change by the amount of your vega. Sergey and Caius, I'm sorry if I mispronounced your name, are both asking about delta. You're asking what delta are you choosing when you build the Condor? Do you always sell the 15 to 25 delta? 15 to 25 is about right. Basically, your delta helps you determine the probability of your trade, guys. And hold that question, both of you guys, until I explain what the Iron Condor is. And then that'll be more relevant for everyone. An Iron Condor, some of you might be thinking, hey, Passarelli, I signed up for an Iron Condor presentation. What's with the credit spreads? Did you forget what presentation you're given? No. I basically already explained an Iron Condor. You just didn't know it. An Iron Condor is 2 credit spreads, one put credit spread and one call credit spread on the same underlying at the same time. Both are typically out of the money. The goal is to profit from theta while losing little to statistical volatility on both credit spreads. And ideally, we want to see the stock close between both break-even points at expiration. So, you can kind of picture the call credit spread on the right side and the put credit spread on the left side. With the call credit spread, we want the stock to be below, the strike that we sold. With the put credit spread, we want the stock to be above the strike we sold. So here, let me make this more clear for you here. Like this right here, call credit spread, right? This right here, put credit spread. Combine them, and we've got an iron condor. With the call credit spread, we want to stay below our strike price. With the put credit spread, we want to stay above our strike price. So we kind of got to be in the middle. It's a direction-neutral trade. You ever see a stock where you're looking at it and you're like, boy, this is a boring stock. This stock's been trading in a channel for 3 months. I don't think it's going to break out of that channel. And if you've never traded options before, you might think, well, geez, how am I supposed to make money with that stock? It doesn't really move. This is how you do it. You use an iron condor. Options are so versatile when you're creative enough to be able to use them. So just consider this as one big trade. Even though there's 4 options, consider it to be one trade. Long put, short put, and then the at the money somewhere in the middle. Short call and long call. So when we're putting on an iron condor, we need to do our technical analysis. We're looking for stocks in a channel, bouncing off both support and resistance. And, okay, now is the time to talk about picking strikes. There are really probably 3 main techniques for picking strikes for an iron condor. One technique is very, very complicated and convoluted. And sometimes people who want to seem smart use this one, but I don't think it's the smartest way to do it personally. You use volatility to find the standard deviation that is expected between now and expiration and coincide your strikes as best as you can with that standard deviation. That's probably a little too fancy. It's unnecessary. Some people like to use delta. The short put strike and the short call strike, they should be options that have a delta of, you know, whatever, 20 to 30 or so. That's an okay way to do it. Maybe 15 to 25, like somebody mentioned earlier. It's an okay way to do it. But you want to know the secret? I mean, as well as there can be a secret, it makes the most sense to set your short strikes with your support and your resistance line. Because if there's a stock that's in a channel and every time it gets to 80, it bounces, it goes lower, and then every time it goes to 70, it goes higher, and you're trying to say, I got to pick 2 strikes that think the stock is going to stay between. Which strike should I pick? 70 and 80. I mean, the stock chart helps you with that. Use support and resistance to set your strike level. Makes so much more sense. No expected news coming out. And volatility needs to be moderately expensive. You need to get edge on this. Otherwise, you're putting yourself at a disadvantage unbeknownst to you. And you want a credit of at least 20%. Back up. On a payout of at least 1 to 3, risking 3 to make 1 or better. They're still high probability trades. You want at least a credit that's 20% of the width of your wings. So if like one of your credit spreads is a 50-55, it's $5 wide, you need a credit of at least $1. Never, ever, ever less than 30 cents. Even if you're doing a really super low price stock like Ford or something, Ford Motor Company, don't sell an iron condor for less than 30 cents. Even if it is more than 20% or more than a 3-to-1 payout, it's just not worth it if you're selling for less than 30. So let's say we have a stock, earnings are out soon before the market open, not confirmed. Maybe it's confirmed, maybe it's not relevant. There's no dividends pending. It's not really a story stock. There's nothing really going on in this stock. Whoops. Getting ahead of myself.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.